and we'll talk about this from the standpoint of an equity, of a stock moving down. So a stock moving south in and of itself is not a trigger to sell. Our sell discipline is more focused around, has there been a fundamental change in the company? In other words, has there been a management change? Has there been a change in their focus? Have they sold off a piece of their business that we really liked? Or have they bought a business that we don't like? It has to do with valuation. Is this stock, is this company now trading at a valuation or at a multiple that we have a harder time seeing an upside to? Or is the reason we're holding this stock different from the reason we bought this stock? And if we buy a position and it starts to go south, everything moves up and down, but if it starts to go south in a meaningful way, disconnected from the market, we're immediately going to understand what's pushing it that way, which is different from why it's going down. But if there's a lot of sell-side activity on that and people just want to be out of that name, or if there's if a similar company was just purchased for a fraction, and the world starts to think, hey, this company is trading at too high a multiple, and it gets sold off. Very frequently, we have by the time we end up buying a stock, our confidence in understanding that company is extraordinarily high. So if a stock pulls back 5 to 10% outside the market norms, our first reaction is typically we want to increase the position size at that level. An example of maybe a time when that was not the case, Moody's and McGraw-Hill, both ratings companies. 2008 hit. 2009, these companies got decimated, and largely because their core business was under fire. So you can look at the earnings and you can look at the projections and you can say, here's a company that has always done this, and they're viewed as a leader in the industry, and it's a very difficult industry to get into. All the reasons value investors look to own a stock. You have all of those. But if their core business is under fire, we don't want to be involved in that. And so that's one of those questions where we would probably shoot first and ask questions later. I'd rather be out of the name and miss some upside than stay in the name and have a real significant loss. But it needs to be a substantial, fundamental change in the company. Just because something's going down, great examples. We were not buyers of Apple for a very long time, and it looked like we were just consistently wrong. And that ran all the way up to over $700. We just couldn't wrap our head around that valuation. That stock plummeted to under $400. We got in at $398. If we had owned it before then, would we have sold it if it went down? Probably not. But largely because we're value investors and we're not growth investors, we're not momentum investors, we're going into a company with a tremendous amount of faith and understanding and belief. We're owning it at a value that's less than its intrinsic value. I'm not sure if that answers your question, but that's how we approach it.